is Eric. I am a partner with Ide Bailey, and today I'm speaking to you from Northern Virginia, where folks are a little tired after last night's baseball game, but definitely euphoric. And so, for my friends in Southern California who are Dodger fans, I feel your pain. I'm a Red Sox fan as well. So, on that, let's get on to the webinar. This is part one of two parts, and today we're just going through the basics on GASB 87 leases. The agenda is right in front of you. We're only going to really hit the high points because we don't have the time to delve a little bit deeper. The deeper dive will be in about 5 weeks, and I'm sure coming up in 2020, as folks implement both on the preparer side and the auditor side, and maybe there might be some users on the call as well. We might have a few more sessions on GASB 87. It is that pervasive. So some of the basics, first and foremost, this is a global change. It's not just GASB doing the changes. Some of you may know that FASB issued similar standards a couple of years ago, and they're in the midst of implementing their changes. However, there is a proposal out to delay the implementation for some organizations for a year. I'm not sure what the current status is of that implementation, but it will not affect the government implementations as well. And as you also know, existing GAAP has been around forever. A lot of us know existing GAAP. It's been ingrained in us. It was largely the FASB standards that were issued back in the 1970s and still being used as of now. And in some cases, we even built accounting systems with lease provisions with those old standards. And can you imagine? They're 40 years old now, and they haven't really changed all that much. Also, governments are different than other organizations in the fact that we could be on both sides of the transaction. We could be lessees and we could be lessors, and sometimes within the same reporting entity under current GAAP. And as we'll talk about in the next webinar, that GAAP will be changing. And as I mentioned, the existing GAAP has been around forever. And we had, I remember in my CPA exam studies, we had to memorize these four provisions, and we had to know it and love it, can't live without it. And sure enough, there was an essay question in the CPA exam back then on amortizing a lease. And we had to know these four provisions off the back of our hands. And if we didn't trigger these mechanisms, sure enough, they were operating leases. And you have situations these days where you have operating leases lasting decades. The disclosure hasn't changed all that much. You have capital leases in one section, operating leases in others. I'm in the midst of updating the disclosure manual for 2020 that is put out by Wolters Kluwer Commerce Clearinghouse, and some of the underlying data set disclosure for operating leases you see around the country is amazing. You have some cases 99-year operating leases, and in many cases, those operating leases really are non-cancelable leases. And yeah, they may have an issue in terms of what's called a fiscal funding clause, but all those standards are about to change because we're going to a single approach based on the right to use space. So, for example, I'm standing today in an apartment building in Northern Virginia. For the time that I am in this building, I have the ability to use it as long as I pay rent. And as such, if I don't pay the rent on my apartment, well, guess what? The landlord comes and locks me out of my apartment. And so I have a right to use that space. And under the conceptual framework, that right to use space is an asset. But I also have a liability, and I have a liability because the fact that I have little or no discretion to avoid that liability that is due to a landlord. Now, there are some exceptions that are built into 87, and actually, some of those exceptions are getting less and less and less each day because GASB's working on those exceptions and whether or not they do fit the model of a lease, and if they do, should they use the lease framework that is there? And there are a couple of exposure drafts that are out for comment and are being redeliberated right now that are beyond the scope of today's session. But the bottom line is the underlying assumption is that most leases are financings, much like the old financed purchase leases, but we're not taking ownership. I'm not taking ownership of my apartment when I'm getting ready to move out of it, in a couple of weeks. Well, guess what? I just hand the keys back, and there you go. There are some exceptions in terms of a short-term lease. And there is very specific language on what truly is short-term. And before you implement GASB 87, right now we call those operating leases. So a short-term lease at the beginning of the lease, and without any form of renewal or renegotiation of the language, has the maximum possible term under the contract, including any option to extend of 12 months or less. And that's any option to extend. And we'll go through some fact patterns in a little bit, but that is any option to extend of 12 months or less. If that's the case, then it is a short-term lease. The exceptions I talked about, you can see on this screen, and as you can see, a bunch of those exceptions are in the midst of potentially going away. For example, on software, and a lot of software these days are app-based, cloud-based, and the exposure draft of subscription-based information technology arrangements may take care of that, and that may become GASB 96 next year. There is an exposure draft out for service concession arrangements, which may overturn or eliminate GASB 60. That may become GASB 94 or 95 next year in the public-private partnerships, public-public partnerships, and availability payment arrangements. And again, beyond the scope of today, conduit debt is already GASB 91. And those of you who call leases, especially state revolving fund loans, and you call the arrangement with the underlying borrower a lease, well, some of that terminology may need to change, especially when folks implement GASB 91. Any form of transfer of ownership without a termination option, that is a financed sale or a financed purchase. Regulated leases, which we'll talk about in the next session, those have special provisions built into GASB 87. Power purchase arrangements and agreements that are structured as leases, those are held aside for now. The GASB may or may not take up that as a special project. And I know some of our clients and friends are indeed utilities, and you know that there are special arrangements for power purchase arrangements. So what is a lease? And this is very specific language. It is a contract between a willing parties that convey control of the right to use another entity's non-financial asset, the underlying asset, for a period of time as specified in the contract in an exchange or an exchange-like transaction. So going into my case, for example, I have control of my apartment for a specific period of time, however many weeks or months I'm in that apartment, and I'm paying a market-based rent in an exchange-like transaction. And I'm not paying $1, I'm paying a little bit more than $1 because I'm outside of Washington, D.C. And in exchange for that consideration, that rent, I have the use of an apartment, and that's an exchange or an exchange-like transaction. So, given that guidance, there is some implementation guide questions that are out there. Well, what if there's exclusive, and I mentioned this term, control. Well, what if there's exclusive use of the apartment or, any other non-financial asset for 3 days a week? What happens there? Well, question 4.2 in the implementation guide stipulates the answer to it stipulates that in determining whether a contract conveys control of the right to use an underlying asset, a government should assess whether it has the right to obtain the service capacity from that asset and the right to determine the nature and use. And if the government specifies that if the contract specifies that the government has control of those rights 3 days the week, 3 days during the week, the control criterion is met. And the provision of the lease definition that the contract be for a period of time does not require uninterrupted control. And we see this, on occasion where government leases office space for a couple of days a week and shares it with another entity. And, in some cases you call that hoteling, and that is a lease. Now, I did get a question earlier this week on easements, and actually from one of my partners. And the question is, do easements meet the definition of a lease? And in some cases, yes, and in some cases, no. And the problem with easements is some of them are perpetual easements, meaning that there's no definite time period. And if there's no definite time period, including renewals, or maximum possible renewals, then it doesn't fit the definition of a lease. And in that case, it's a contract. And also, in some cases, easements are only for $1 a year. And if it's only for $1 a year, well, that's not really fitting the definition of a lease. So let's go to the first polling question. And Amy, do you want to read these or me?
Oh, it doesn't matter, whatever you want.
All right, why don't you go read them?
Okay, sounds good. Polling question number 1. What are the required elements to meet the definition of a lease in accordance with GASB 87?
Excellent. The vast majority of you picked the right answer, which is item C. And again, that is very specific language for good reason in GASB 87. And again, you're going to see this framework come up again and again as we head into the future. And that contractual language, ceding control. And so keep that if you do have that printed out dog ear that slide, certainly if you have it available to you electronically, bookmark it. You're going to see this over and over and over again. So using that framework, you see a lot of these different things I mentioned before, where if a government lessee has the right to use an asset, in this case land, with a fair value rent of 100,000 a year, but only for $1 a year. And you see this a lot. The implementation guide has a question to this matter, and sure enough, the implementation guide says no, this is not a lease, and it's simply because it's not an exchange transaction. It's not value for value that are essentially equal, and since it's not an exchange transaction, it's just a normal contract, and so you'd have a contract for 100,000 for $1 a year, for however long it is. But remember, if there are some of these perpetual contracts out there, that might be just cash flow. And of course, remember materiality. Another common thing, and we're seeing this so much more, these days in terms of solar activity and solar farms and so on. And so here we have a government entering into a contract with open space land with a private solar company to build a solar farm on government property. And there are various provisions there. But in this case, the GASB 87 says that with this particular fact pattern, GASB 87 does not apply. And it's simply because, there isn't exclusive right to use the land? And that's question 4.7. And if you drive along the highways, especially here on the East Coast, a lot of the land alongside of the highways is being converted to solar power use. And, that's a good thing, of course, but you have to be careful as to whether or not the provisions apply in GASB 87. Otherwise, it's just a standard contract. All the things in the bottom there are going to have varying provisions. Another one I see a lot, and I get a lot of questions these days as governments are starting to realize that 5G cell service is a really big thing, but the cell phone companies want to put little tiny cell towers on every telephone pole because the transmission is different than 4G. As such, I'm getting a lot of questions on cell phone towers, and it all comes down to those basic provisions that are within GASB 87. They have to be met, and if they're not met, then chances are they are not a lease. It's just a standard contract. So again, we're down to control, and that's one of those aspects. And you have to have some form of present service capacity from the use of the underlying asset and the right to determine nature and use of the manner and the use of the asset. So, for example, if a government is leasing office space, they have the right to determine the manner and use of the underlying asset as long as they meet the provision of the lease contract. So there are a number of other implementation guide questions about control. Here we have one on open ranch land. What if a rancher is required to allow access and use by others? Well, that's not control, and that's question 4.4. And again, there has to be that exclusive right or control of that asset. And are there substitution rights that are essentially the identical asset? Well, yeah, those are very, very common. And in fact, the question says a contract that allows the vendor to replace the underlying asset with essentially an identical asset. Does that substantive right of substitution affect the evaluation of whether or not the contract conveys the control? And the answer is no, you still have control of that asset. Sometimes the government sees that, especially with vehicles, where there is essentially a right of substitution as a lessee, but sometimes the lessor has a right of substitution as well. So in your mind's eye by now, hopefully you understand that there's not going to be a difference between capital and operating leases once you implement GASB 87. Most of it, if not all of your leases may look exactly like financings do today, except you're not going to take ownership at the end of that lease. But if you are taking ownership at the end of that lease, well, guess what? That is a borrowing or a financing. And I get a lot of questions. I've gotten a lot of questions so far from clients and prospective clients and friends saying, gee, how should I account for a financing? Well, that's just like if you're essentially the lessor or the seller, well, it's a note receivable, just like any other mortgage. Or on the other side, it's just like a note payable, just like a mortgage. You're going to have principal and interest and so on. And of course, be careful about the disclosure on that. It probably wouldn't go in your lease disclosure, but it's some other, if you're a buyer, so to speak, it goes into your long-term obligations. And remember also that right of substitution. It is very, very common in public safety where there is a right of substitution. And also, there may be some language in there allowing the vehicles to be purchased, or even the copiers or something similar, the vehicles to be purchased at the end of the lease for $1. And if that's the case, that's a financing as well. And here's typical language that I've seen, and this is actually from one of our clients, where indeed the rights transferred at the end of the lease for pretty much $1. So, okay, we talked about the period, the lease term being an integral part of the lease standard. So how do you determine the lease term? A lot of it is a guess, depending on past practices, depending on the language that is built into the lease document. By and large, you start off with the non-cancelable period, the period where you have to make your payments, and then you adjust it by your lessee and lessor's options to extend if reasonably certain of being exercised. Now, that reasonably certain, I italicized it because there's a question as whether or not there's some form of formula or magic potion to determine what is reasonable certain. But if you read the basis for conclusions to GASB 87, the basis for conclusions doesn't provide any definitive answer, but by and large, it is more than probable. And for those of you who put together, for example, legal confirmations or doing the accrual for legal liability, you know what probable tends to be. Some folks say it's 75% chance of loss, 80% chance of loss. Well, reasonable certainty is more than that 75 or 80%. Or whether or not there's reasonable certainty to terminate that lease. If there's some form of certainty of it not being exercised, you adjust the non-cancelable period upward. But then you exclude the cancelable periods. And I say down here that, the old 1-year leases with 99 options, all at the behest of the city council, well, those days are going to come to an end once you implement GASB 87. Now, you can reassess if any of those probabilities change. And instead of reasonably certain, you're going to terminate. And you see that a lot, especially with technological changes. So for example, say you're leasing a copier and then all of a sudden, the technology changes and you don't need that copier anymore. Well, when you did your initial assessment, you were reasonably certain to extend, but now you're not going to extend. You're going to have to adjust your period. So there's some implementation guide questions on this, on that tend to deal with trying to determine what the period is. So, for example, in 4.12 here, just to give you a little bit more of a flavor there, a developer builds and leases a building to a government. The government's required to make payments during the construction period, but the government doesn't have access because it doesn't have a COO. When does the lease term begin? Well, it doesn't begin until the government has access to the building. So in a sense, there's a bit of a prepaid asset, probably a prepaid expense during that construction period. And then once the construction period is over, the COO is issued, the government has access to the building, well, then that converts into a lease. Well, what about a holdover period? Month-to-month holdover period. Here in the fact pattern of the next question, the government has a non-cancelable lease for 5 years, and at the end of 5 years, both the lessor and lessee have the right to cancel a lease at any time and may continue the lease using the same terms. Is the month-to-month holdover period included? And the answer is no. The lessee has not contracted for a non-cancelable right, and the lessor is not required to continue providing the asset. That is, it's cancelable by either party and therefore is excluded as of the lease term. Well, and what if both parties have the right to cancel? There's another question on if only the lessee has the right to cancel. All of these are in the implementation guide in questions 4.12 going up to 4.16, and I encourage you to read them. But again, to use a real example with my apartment, 30 days before I'm projected to move out, I got an email from the landlord saying, hey, we'll continue the terms and conditions. Are you going to move in or move out? Please confirm what your status is going to be. A little pop-up came on your screen and you clicked a button. And I said, I'm going to move out. And sure enough, that ended my period of lease. And that goes to if I was a government or a FASB entity, well, I would probably have to I would probably have to adjust my accrual, my lease period. So, with that in your mind's eye, you should say to yourself, gee, it's going to be darn difficult to have what used to be called operating leases. It's going to be next to impossible. Again, you got to fit the definition. The maximum is 1 year, uh, 12 months or less without a probability of being exercised. And in my mind, there's going to be very, very few operating leases. I can imagine a situation where, for example, let's say you had a fire in City Hall, and there's going to need to be some remediation that'll take 6 months, and over the 6 months. You need to take temporary office space, but you're going to move back in. Well, guess what? That is probably going to be an operating lease. But again, all the facts and circumstances are going to be different. So let's go into our second polling question, Amy.
All right, polling question number 2. A short-term lease is present when a government enters into a 12-month non-cancelable lease with the option to renew 12 months at a time for up to 49 times. True or false?
That is definitely false, and a lot of operating leases currently are structured like that because of the fiscal funding clause, and again, you have to go back to the basic definitions of what is a lease and what is a short-term lease, and if you can't get beyond those basics, chances are it's not going to be, especially for a short-term lease, it's not going to be what we call today an operating lease. So let's go to the third question.
All right, polling question number 3 here. A short-term lease is present when a government enters into a 6-month non-cancelable lease and an option to extend another 12 months after the non-cancelable period. The government is not reasonably certain this will exercise that option. True or false?
Okay, well, this one's mixed, and this is actually a implementation guide question. And for those of you who are taking notes, this is question 4.18. And again, it says a government enters into a lease with a 6-month non-cancelable period and an option to extend for another 12 months after the non-cancelable period. The government is not reasonably certain that it will exercise the option to extend the option to extend, and therefore assesses the lease term as 6 months. Is the agreement a short-term lease? And the answer is no. And it refers to paragraph 16 of GASB 87 that a short-term lease has a maximum possible term under the lease contract of 12 months or less, including any options to extend regardless of their probability of being exercised. Therefore, the lessee should report a lease liability and a lease asset. However, the lease term would only be 6 months. So it's a little bit of a curveball. And again, I encourage you to maybe circle that question if you happen to have any potential of this fact pattern being there. So let's get back into, some of the basics here. So how do you measure this? And most of our clients are lessees. We have a few lessors as well, and we'll get to that. But lessees, the first thing you have to do once you know the time is measure the liability, and then the offset will be an intangible asset for the right to use the underlying asset. Now, I have gotten questions. How do you what do you note that intangible asset is? And there's no real gap for presenting that intangible asset in specific text, as long as it's somehow presented in your statement in that position as intangible asset, perhaps capital leases or something like that, or leases or leased property or leased equipment, something like that would be fine. I haven't seen anything from the GFOA as well as in terms of how to denote a particular asset on the asset side. So certainly keep a watch out because I'm sure there's something coming soon, perhaps as a best practice. How do you measure the liability? Well, you have the time because you know the lease term. You have the perhaps payments that are embedded within the lease document. Maybe you even have an interest rate, and we'll talk about that when we get there. But you measure the liability using a present value calculation exactly the same as you would a mortgage, in exactly the same way you would do a capital lease these days under current GAAP. And so it's the same calculation, principal, interest, and time. And you adjust whether or not it's a fixed payment or a variable payment based on some form of index. And by the way, yeah, based on the index, breaking news, GASB issued an exposure draft. Some leases are pegged at LIBOR, and some of us know that LIBOR is heading off into the sunset because of fraud that went on a number of years ago in the setting of LIBOR interest rates. And as such, the GASB is broadening the definition of indexes that can be used, or at least proposing to broaden it. And then you adjust for any sort of residual value guarantees that are probable of being required to be exercised. And then you adjust for any form of termination penalties based on whether or not they're probable of being exercised. If you have some form of performance measures that determine the value of a lease. For example, let's say you're billed by a leasing company for public safety vehicles based on mileage. And that's not really a lease. The liability doesn't include that. And so, yes, if there's some form of base that's non-cancelable or fixed, you would only include the base, but you wouldn't include any sort of mileage or things like that because that is entirely variable. And so beware of those sort of things, especially in vehicles and copiers and so on. So how do you determine the lease asset? Well, the lease asset would be equal to the lease liability unless there's some form of prepayment. And that prepayment, though, would need to be adjusted by lessor incentives, meaning, a buy down or something similar provided by the lessor. So let's say you're leasing a vehicle and they require the first month down or something like that, or $5,000 down, but they also provided you maybe a $500 incentive. Well, you need to adjust that on the asset side. The asset side is amortized using something systematic and rational. Now, I've gotten a number of questions on that. Gee, what is systematic and rational, and how long do I amortize it? Well, you amortize it over the shorter of the lease term or the useful life of the asset. So if the lease term on a PC is 5 years, but the technology will be will be brand new 3 years from now. Well, the useful life may be 3 years instead of that 5-year lease term. But then what is systematic and rational? Well, the GASB in the implementation guide has a number of examples of systematic and rational, but I think in practice, a lot of folks are going to amortize the same way as a liability. So that using the effective interest method, much like a mortgage, and that way you're not amortizing the asset faster or slower than the liability, and that way you won't be quote unquote upside down based on the usage of the asset or the passage of time. And again, the amortization can be based on your form of depreciation policy, but be careful on that, because sometimes the recognition of assets and the amortization of assets are different than recognition of liabilities and amortization of liabilities. So beware of your summary significant accounting policies, and we'll talk about that when we get to implementation in the next session. And the amortization is as of amortization expense. So the guidance again is using is using the present value of the liability as essentially your liability, much like a mortgage, and you figure out the lease term based on the facts and circumstances in your lease, and you adjust based on whether or not there's termination and cancellation provisions and so on. Now, I did somewhat allude to about 30 seconds ago, gee, assets and liabilities have different thresholds of recognition. Certainly I've been getting a lot of questions. Gee, I got a $50,000 capitalization threshold in my government. It's a pretty large government. Do I have to implement GASB 87? Gee, everything is below $50,000. Well, it depends. You have to consider both the asset side and the liability side. You wouldn't want to recognize a liability but not have an asset, because then that'll mess up your statement in that position. You're going to have an unrestricted deficit based on that transaction because you recognize the liability, you didn't recognize an asset. So you might want to start thinking about your summary of significant accounting policies pretty soon if you happen to have a pretty high capitalization threshold, but your liability threshold is fairly low. And of course, obviously, bring your auditor into the discussion as to how to settle those two, and make sure they know, because that's a very significant accounting policy on both the asset side and the liability side. Now, there are some leases that are adjusted to the consumer price index. For example, let's say you're an airport, and well, actually, let's use something different. Let's say you have office space, and it's because of the variability in office space and the tenancy in the offices. For example, where I'm physically standing right now, right near where Amazon is going to be building its HQ2. The lease rates seem to vary every single day on the same exact space, and as such, you might even have a rate that is pegged on CPI. Now, how do you measure that? Well, there's a question in there, 4.26, in terms of how you measure your liability based on CPI, and basically you use the facts and circumstances at your reporting date. And it may change throughout the life of the lease, and you just re-index things. Um, and again, as I mentioned a few minutes ago, don't include any sort of variable rate payments based on usage. That's not part of the lease liability. Now, I also mentioned about these rights of termination, and you have to measure whether or not it is reasonably certain, more than probable, that there's going to be some form of extension or some form of termination at whatever points there are in the lease. And so, as I mentioned before, I got an email from my landlord saying, gee, Eric, are you going to extend your lease or not? And the answer is no, I'm not. And these options are all relevant factors. And in fact, there may be an economic disincentive for you to lease. So, for example, let's say the landlord said to me, gee, Eric, we're going to raise your rent by $2,000 a month. I would say, well, thanks, but no thanks. That's just not in the cards. And so there's an economic disincentive for me to stay in my current apartment. And as such, that's an option. And so, this gets to the heart of the matter of fiscal funding clauses. A lot of governments we deal with say, gee, under the current lease provisions before GASB 87, I got this thing called a fiscal funding clause. I got to wait until the city council, the state legislature, and so on. Well, the question is, when was the last time the city council or the state legislature failed to appropriate for that lease? That's a contract. And as such, we have a lot of clients say to us, well, they've been appropriating for the last 60 years on that lease. So I don't think they're going to stop appropriating. And as such, that's really, that's really not relevant then. And so GASB did understand fiscal funding clauses. There is extensive discussion on fiscal funding that is built into GASB 87. So let's get into polling question number 4.
All right, polling question number 4. This all kind of relates back to the 2 and 3. A short-term lease is not present when a government enters into a 16-month lease that can be canceled at any time after 6 months by the government, not the lessor. True or false?
And remember on this one, that it can be canceled at any time after 6 months by the government. Well, this one actually is true. And as long as a short-term lease is not present when it enters into a 16-month lease that can be canceled at any time. But the original period is 16 months. And again, this is actually a implementation guide question as well. And hang on, let me just see which one it is. Short-term leases. It is question. It's question 4.19. And the answer and the maximum possible term on this one is 16 months. And again, you might want to reread paragraph 16 of GASB 87. So let's get to a practical example here over the next couple of minutes before we close. Here we have a backhoe where the day we implement GASB 87, and this particular government is July 1st of 21, we're going to lease a backhoe for 5 years with 2 potential renewal periods. The incremental borrowing rate of the government is 6%. After the non-cancelable period of 5 years, the government may cancel, but the government has a lengthy history of renewing at least for the first 2-year period. But the second 2-year period, the technology and the use of that backhoe is such that it just doesn't make sense in wear and tear. There's no early termination. There's no transfer of ownership. Payments are $1,000 a month on the backhoe, and we have a reasonable certainty going on. And so you can almost put it into a timeline. And the second 2-year option period, probably not. We're probably not going to lease it beyond year 7. And so as such, if you have this printed out, you can circle the 7 because that's probably my lease term because we have at least 5 years where it's non-cancelable. And then the first 2 years, we have reasonable certainty that in history that backs us up that we're going to lease it for another 2 years. So you can even do things, say, in a table or a worksheet and things like that. And certainly, I recommend as a good practice for every lease to do something like this, to document your lease term, maybe even do the timeline. Whatever works for you is fine, as long as you document your decisions, because as well as I do, there's probably going to be some auditing on leases simply because of this major change. So we've calculated our lease. Our lease term is probably going to be 7 years because the second lease term probably doesn't make sense. Here's another way to do it, and this is actually from the AICPA. We don't have a right to terminate. The first 5 years, it doesn't. It is a non-cancelable period, so those are all no's on behest of the lessee or the lessor. We have a reasonable certain to extend in years 6 and 7, but in years 8 and 9, for the lessee is reasonably certain not to extend because of the technology changes and so on. So we're not going to include them. And so any one of these could work to document your decisions. So here is your documentation of your journal entry based on those fact patterns. Our present value is 68,453, and I gave you the Excel formula. You do not need special software for leases. For GASB 87, you don't need it. And we'll talk about that during the next webinar, whether or not you need software. Well, guess what? You don't. There are 2-year options, but we're only reasonably certain for the first year. Here's our debits and credits as of day 0. We don't have a prepayment. Our debit is a right to use intangible asset. Our credit is lease liability. And there's our first payment right there. And I showed you the formula of how to get there. Here's our amortization schedule. Pretty easy. Again, we can do this in Excel very easily. I gave you the formula there of how you do your amortization. Our payments shows the amortization using the effective interest method, and any method can be used to amortize our liability as long as it's the effective interest method, or any I was going to say any method can be used to amortize the asset, but most of us will probably amortize the same way as the liability. Your amortization of your lease asset, you can group things together. I mention a lot vehicles, and we see a lot of public safety. They lease, say, 100 police cars at the same time. Well, de-amortize 100 police cars at 100 different entries? No. As long as they are closely aligned, signed with the same lessor, signed at the same time with the same terms and conditions, instead of having 100 assets and 100 liabilities, maybe you have one. Now, do you need to keep track of all the different vehicles or laptops or things like that? Sure, you have to have some form of inventory method, but beyond that, you don't need any special software to categorize that. Again, the amortization is systematically and rationally. Most of us will probably use the effective interest method, although some of us will use straight line just to make things easier. Here is our journal entry to get from our fund perspective to government wide. Our fund perspective, let's say we sign the backhoe lease in a capital projects fund. Our debits and credits will be right there. I apologize for the indents not quite working, but that's PowerPoint for you. That's 68,453 from our backhoe. Would be another financing source under current GAAP. Talk to me in about 4 or 5 years. That might be different, and we'll talk about that next year when the exposure draft comes out for the financial reporting model. And then here is our conversion to our entity-wide statements. Again, this is something you may want to dog ear to show how you do your debits and credits, because you may be doing that over and over and over again. Here is our first payment, and again, let's say we were paying it out of a capital projects fund or even out of the general fund. We're going to have interest, expenditure, and principal based on our amortization schedule, a couple of slides back. And here is our conversion to our entity-wide, and then, oh, by the way, we really got to move from our long-term liability to our short-term liability or current liability because of the passage of time on our entity-wide financial statements, or in fact, in proprietary fund statements, you would want to do that as well. Now, at the end of the first year, what shows up on our statement of net position? Well, here is our liability and here is our assets. Now, let's say we amortized our asset using straight line instead of the effective interest method. Notice the difference in the numbers. And so this is why that becomes an important policy decision of the government. Do you amortize your asset straight line, which is easy, it's great, perfectly acceptable, or do you amortize using the effective interest method? And this should answer your question simply using our backhoe. We're going to have two different numbers. Our liability is going to be more than our asset. Do you really want to have that happen? Is up to you. There are other aspects of GASB 87. First is components. And a lot of leases come with components. So for example, in my apartment, I had to pay my utilities. Well, that's a component lease. And I had to pay for my heat, my light, cable, so on, security. And as such, that is a component lease. Now, if you do know these amounts of heat or light based on past experience or maybe a long-term contract in a similar piece of property, well, then you need to identify those as liabilities. You need to separate out the lease and the non-lease components. And it's common where you have separate maintenance agreements, especially for vehicles and pieces of equipment, that need to be separated out. And this is where that capitalization threshold policy comes into play. And GAAP is fairly specific, saying that you do need to separate this out and not not keep this aside. Uh, Combinations are similar to components. And again, a combination is essentially a negotiation or a package of like kind assets. So instead of having one backhoe, you have five. Instead of having one police car, you have 20. Instead of having one laptop, you have 200. Those are combinations. And now you still could have maintenance components on the backhoe, the police car, or the laptop, for example. For example, let's say the laptop, all the software was managed remotely by a subscription-based information technology arrangement, like in Google Chrome or Chromebooks. As such, you have a componentized lease. So let's say there is a $2,000 payment that goes to your leasing company. Well, that's just a contract. And if it's a long-term contract, that might be a longer-term payable. But most of us in practice will probably just say, okay, that's contract expense or maintenance expense, and our credit is going to be to cash. Here's the steps to identify components. Use observable inputs as much as you can, as much as it's practicable. And most of our common area stuff and maintenance and security, those are long-term contracts, and you can pretty much identify those. There might be some lease incentives. And you see this a lot in leasing cars or leasing office space. For example, I could, before I moved in here, they gave me an incentive saying, if you sign for 3 months, we'll give you 2 weeks free. And as such, that is a lease incentive, or we'll pay your closing costs, or 0% leases on, instead of Caterpillar backhoes, 0% leases in all new Toyotas. You see those a lot on commercials. That is an incentive. Or rent holidays or forgiveness of principal. So what are you supposed to do? You're supposed to reduce the amount of asset by the incentive during the period of receipt. And that might not be in period 0. It might be in period 4 or period 8. And so back to my apartment, since I got the first 2 weeks for free, I reduced my rent the first 2 weeks. Now there might be variable rate or something like that, but here's an example of how to do it. Put it together a spreadsheet to have an incentive based on a payment in period 2. And you just book the present value of it, and that's all it is. And this is from a worksheet from the GASB. What do you do about modifications and terminations? Well, it depends on the language that is embedded in the lease. Then there might be a modification based on an interest rate change or based on a extension of the lease or a reduction of the lease term. As such, it's just sort of a remeasurement or a modification. If it's a termination, there could be gains or losses, and these could be frequent, where the incentive says, something, I need the apartment, I need to terminate your lease, and there could be a gain or a loss. And here's how you calculate the gain or loss, referring back to our backhoe. There's no need to adjust the discount rate because guess what? We're terminating the lease. And as such, if you take a look at the amortization schedule a few slides back, this termination actually results in a gain. And since it results in a gain, that would be a special item. And you can do the math on your own, but take a look at that amortization schedule. And in deference of time, I just need to get going. Here's your debits and credits all on one sheet. You might want to dog ear this page or circle it for both the lessee and the lessor for the initial period as well as for subsequent reporting. Notice for lessors, there should be no liabilities unless there's some form of contractual liability to provide services, but that's very, very, very rare in a lease. It's usually just a deferred inflow of resources for lessors. Lessees, you're going to have a liability, of course, and an intangible asset. Disclosures are very similar to the current model, very similar to debt, the terms, conditions, and so on. The lease asset would and the accumulated amortization. GASB's requiring those to be reported separate from capital assets. And the lease asset would be by major class. So leased property, leased equipment, leased land, things like that, by major classes separate from capital assets. You would disclose, just like debt, your principal and interest going out 5 years, and then principal and interest aggregate principal and interest thereafter in 5-year increments. Any form of commitments and impairment losses you would also disclose. How do you implement? Well, the effective date is periods beginning after December 15th of 2019, which is this year, coming up in a couple of weeks, a couple of months actually, and then for existing leases, you're going to have to utilize the facts and circumstances of the lease, each individual lease, as of the period of implementation. And that could result in restatement, since many leases obviously are operating leases. Here's an example of how to implement, and there may need to be some form of adjustment that is needed simply because of the recording under GASB 87 versus an operating lease. And as such, we may have to adjust our liability, even though there's outstanding principal of $21,500. So there's $1,000 beginning balance adjustment that we will need to do to our liability. We'll have to record an intangible asset and adjust our beginning net position. With that, we just hit the mark at the end of our time. I know we have some questions, but I think I'm going to have to answer those questions by email. Is that right, Amy?
Yeah, I mean, it's up to you. We can stay on for about 5 minutes if you want, or I can just send you a list of the questions and we can answer those via email.
Why don't we send the questions by email, and so I can address it directly to you?
Okay, I will get that to you. All right. Well, thank you all so much for attending. Like we said, we will get your questions answered. I'll get that off to Eric today and just give us about 24 hours or so to get those answered. CPE certificates will be emailed out within 10 to 14 days as long as you met the criteria. And we hope everyone has a great day. Thank you, Eric.